Good evening to all of you. Welcome you to today's webinar. Today, the topic is credit debit structures, option structures. Credit debit option structures. First of all, what we will do is that we will explain what we mean by credit and debit structures, and also later on tell you how the performance of this credit structure or debit structure has been there over the last 1 year, 1.5 years. In coming webinars also, we will highlight the probability, also the total profitability of such structures over a period of years. Maybe we'll take 2015, 16, 17, 18, 19, 20 till now. So today we will just stick to the illustration as well as how it performed in the last 1.5 years period. That is starting from January 2020 till date, and also from April 2020 till now, because the reason why we are giving both this is that from January till March or April first week, the market had a very big fall, and then after that there has been a big rally. So we have seen one of the biggest roller coaster rides in the markets probably since 2008-9 Lehman collapse period. So this happens once in a decade. So now if we illustrate the performance, then it will give us a confidence that these structures generally will make money. Maybe we need to fine tune it depending on how we see the volatility of the options. So first of all, let us explain what we mean by credit debit option structures. You are already aware of the basic call option, put option, right? So you are now familiar with what is call option, what is put option. You know, call option means normally if you are a buyer of a call option, you are bullish in the market. If you are a seller of a call option, this is for a buyer of a option. For a seller of a call option, you are bearish. So if it is put, then in that case, if you are a buyer of a put, then you are bearish. If you are a seller of a put, then you are bullish. So the symbols change. So this is for a buyer of a call option, the upside. Seller of a call option expresses it because of a downside view. Similarly, if you are a buyer of a put, you feel the market is going to be bearish, and if you are a seller of a put option, you are bullish in the market. So this is the basics of the call and put option. Various characteristics of these options we have discussed in many webinars, so we are not going exactly into the basics, but one or two important salient points. Normally when you buy option structures, you have to be careful about two things. We have said about the time decay, right? The time decay, the volatility. I think these two play a very important point, and these two things decide about the type of structures you need to take at different points of time, whether in a bullish scenario what type of structure you have to take, and in a bearish scenario what type of structure you have to take. But generally speaking, a buyer of an option has a problem with the option because of the time decay. Second is the volatility. Now when an option is priced and given to you, it has a very important portion called the implied volatility. That is what traders feel about the market's up and down movement, either on a daily basis or at the end of a particular period. Now we need to compare the volatility which the option price gives with what has happened in the past. So if the option volatility that is being given by the present market situation is much higher than what we have evidenced till now, then we need to be careful while buying the option, right? So it's a very, very important point that I am making. That is, the option will have what is called an implied volatility. Implied volatility, okay? And that implied volatility, so just like that, don't go and buy an option. Now that we will now tell you with the illustration. Now you need to be very careful about buying an option, mainly because of the implied volatility figure. Second thing is that we need to worry about the time decay. So this time decay is going to be a major deterrent for any option buyer. In order to overcome or negate some of this, generally structures are put in place, particularly the spread structures are put in place. The reason why we put the spread structures are for two reasons. One is the spread structures to some extent neutralize the negatives of a buying of an option. Like, for example, you have I told you about the volatility, about the time decay. Now, if you buy one option and sell another option, to some extent, the volatility and time decay, of course, that depends on the strikes which you are taking. But for time being, at least accept the fact that you are a buyer, also a seller, okay, in the same side. That is, if you are a buyer of a call option, you are also a seller of a call option of a higher strike. Similarly, if you are a buyer of a put option, you are a seller of a put option of a lower strike. When I mean to say that, it is like this. Now, let us say market is 14,800. You are buying a 14,800 call option. Let us say any tenor, it could be May end tenor also. May end, let us say, May end settlement. And if you are a seller of an option of say 15,100 call option, to some extent, the time decay, of this is taken care of this to some extent. Okay. Similarly, the volatility also, to some extent, the volatility of this and the volatility of this, of course, both of them exactly don't match. But I'm saying that's because the volatility, we have to look at these two as type of independent thing. But if you're a buyer of this and the seller of this, still, if you are paying a premium, because in this case, this is a spread. So I'll come one step by step. This is a spread. Why it is called a spread? The spread means you have got more than one strike. If you are buying only 14,800 call option, then it is a plain vanilla call option. But if you are adding another leg, then it becomes a spread. So if it is only one strike in the same direction, then in that case it becomes a plain vanilla option. If you add one more strike, okay, in the same side, that is you are bullish 14,800, you are a seller of 15,100 call option, then this becomes a spread because you have got two legs. So anything which has more than one leg in a particular structure, you normally associate that with a spread structure. Now, why do we talk about a credit or a debit spread? Now, the credit in accounting terms itself, okay. Credit means you get premia, premia paid to you, that is credit to you. Premia received by you is a credit. Now, premia paid by you is a debit because that is an amount which is debited from your account, right? It's a very simple way of understanding. If there is a debit, so we call as the premia is debited from your account. So that is a premia paid. If it is a credit, that means there is a premia received by you. Okay. So now, whenever there is a net premia paid by you, okay, whenever there is a net premia paid by you, generally think that it is working against you because there will be always a time decay, there will be always volatility, because anything which is a premium, just for just understanding purposes, it is also true. If you verify also, it is true. Now, if you do a structure and if you just look at whether you have received a premium or the premium paid, the moment you have paid a premium, you need to be careful because things have to work within a time frame of the premium that you have paid. The market has to move in that. Suppose, let us say the same spread which we talked about, now 14,800. Let us say it is going at 250 rupees. 15,100. Let us say it is going at say 100 or so. Okay. So the difference is going to be 150 rupees. For this 300 rupees, you are paying, let us say, 150 rupees. Approximately, I am saying that. No, please, no, if you want a correct thing also, you look at it. Now, let us say 14,800 is 311 and 15,100 is 163. So this is 310 and this is 160, let us say. So yeah, difference is anyway 150 rupees. Okay. So 150 rupees is the premium that you are paying here. Now, the moment you are paying a premium, okay, now you know that it has to work. It has to work for you in the sense that you have to get a break even which is 14,950. So at the end of the period, you need to have at least 14,950 or above for you to have made some money. And the maximum is restricted by the spread that you have kept. Now, what is the maximum profit that you can earn in the spread? That is the difference between the two strikes. 14.8 and 15.1, the difference is 300, but you have paid a premium of 150, so your max profit is 150. Same time, maximum loss is also 150. maximum loss is also 150, maximum profit also is 150. Generally speaking, you will always be told, okay, that if you buy a call option, your profit is unlimited. If you are selling a call option or selling a put option, your loss is unlimited. Fine. Theoretically, that's a perfect thing. But does it happen like that? That is one. Second thing is, it may not happen for a very long period of time. That is, the loss, even if you sell an option, the loss could still be limited for most duration. But that's one thing which is called the black swan event. That is, you might have heard this particular parlance. Okay, that is, this is a once in a decade or once in whatever period you call, once in a decade or once in 5 years, such things happen. That is, unexpected movement happens. That is an unexpected movement. Last year, what happened in February-March period? Is a totally unexpected. Nobody even a week before could have thought the market will plunge 35% from the top, right? Similarly, the bounce also, right from 7,500 to 15,000. This was also could not be visualized in a short period of time, within that particular period of time. So these unforeseen events, okay, typically you do not know when it will happen, because of which you are always looking to protect yourself to some extent. Okay. Now, assuming that the buyer of an option is going to make money over a period of time, the seller has to lose money consistently. In our earlier webinars, we have given the analogy of a buyer of an option and seller of an option. The buyer of an option is like somebody who pays for an insurance premium, who takes insurance policy. The seller of an option is like an insurance company. If the sellers of an option has to lose money consistently, it is equivalent to saying that insurance companies also will lose money consistently. That means worldwide insurance companies will have to become bankrupt. Does it happen? It doesn't happen. What happens is, most of the insurance policy holders, normally they may not exercise the option, because if you are taking a health policy, God forbid, you don't need to get any disease. So, but you will be happy to continuously pay the premium. You don't want to receive any benefit out of that, but you just get a feeling that probably you are protected. But end of a particular period of time, in your this one also, the premium that you have paid, you can see that the sum total of policy premium that you have paid probably may be more than the benefit that you may avail one time. Right? This is happening very constantly. The reason I am giving this is for understanding purposes. See, look, you are saying that monthly, yearly. Let us say you are taking a health policy and you are paying a 25K per year, 25,000 per year as a policy. This one. Let us say you are paid right from 40 years and you are now 55 years. Okay. So let us say you are paid 25K into, say, every year you are paid 15 years. Okay. So maybe you are paid 3.75 to 4 lakhs, and if you take along with the interest, let us say it comes to 5 lakhs for the amount that you have paid. And the policy itself for this may be a cap of 5 lakhs, let us say. So over a period of time, there is a chance that you might not have even utilized. And when you utilize it, the sum total of insurance premium that you have paid probably may be definitely more than the benefit that you receive. So actuary companies will definitely work on that particular statistical analysis. They may be mapping up the age group, because there was no point in them taking only policy for people who are already 60 years old, where the chances of exercising for a health benefit or life insurance policy may be much higher. So they will be looking at people right from starting from the age of 25, where there is a low risk group. So from the low risk group to the high risk group they will cover, so that most of the entire bouquet will consist of a lot of low risk holders. So net, even if they disburse some money, they will be happy to receive some profit from their overall premium that you have received, which they would have invested. There are certain risky areas where probably the insurance company itself may find it difficult to take that particular risk. Some big risk, probably some assets being covered in a seismic zone. Those policies, they may reinsure with somebody. That is like the spread. So if you are doing just a sell option, let us say, if you are selling an option, it is like an insurance company giving the policy to you. Insurance policy issued by the insurance company, right? Suppose you do a spread in an option, like now you do a now illustrated 14,800, 15,100 call, right? This is like, let us say you have sold a call option. In this case, you have bought a call option. You have bought a call option here. That means the insurance company which has sold at 14,800, and this is going at 15,100, right? So it is like reinsuring it with somebody else. This spread is something like reinsuring the spread. In the earlier example, I told you there was a debit from, there was a, if you have paid the option, okay, then there is a debit in your account. So that was a debit spread option. So that was a call option and there was a spread. So it is a spread option. At the same time, you have paid a premium if you have bought a 14,800 call and sold a 15,100 call. Since there is a premium that is debited to you, you have got a debit spread. Because you have paid a premium, there are two things which can work against you. One is the time decay, and second, the drop in volatility compared to the option volatility which you have paid. So these two things, so very clear in your trade book, you should enter that. Suppose if you are doing a reverse trade, you have sold a call option of 14,800, you have bought a 15,100 option, and if you have received a premium, the same 150 rupees which I showed you, let us say you have received the premium. Since there is a credit to your account, it is a credit spread. It is a credit spread. There are two things which are going to work in your favor. One is the drop in volatility if it happens, and the second is the time decay. The risk for you is a very significant increase in volatility, but anyway you are covered it with a 15,100 leg. To some extent there is some risk in this particular thing, right? So overall, you make an analysis of this, okay, and then decide where do you stand, what type of personality and character you are, and based on that, you take a decision for whether you want to go for futures, whether you want to go for plain vanilla call or put, or whether you want to go for a spread. So this is one important reason why you take a spread option is basically. One is that you have a limited upside view in the case of 14,800 to 15,100 spread. Second thing is that probably if you are a seller of the spread, you have a feeling that volatility will drop or the time decay will help you. The reverse applies for a buyer of that particular option, right? Second aspect, another important aspect is the margin, okay, the amount of funds that you require, okay. Now let us say in the case of your futures position, let us say in the case of a futures position, okay, what do you require? You have to do one contract, and that one contract today approximately, let us say, is around 2 lakhs of margin money. It could be slightly less, therefore rounding it up. Let us say it is going to be 2 lakhs. But you do a spread option. Now they nowadays they charge, I think, 1.5% of the value of option strike. For example, if you have sold a 14,800 call option, let us say 14,800 into 75 into 1.5%. Let us say this value is around 12 lakhs, so probably 14,800 into 75 into 1.5. Maybe it will come to 16 divided by 100, right? So 14,800 call. Sorry. So the value of the contract is 11 lakhs. For 11 lakhs, 1.5% comes to 16,500, right? So the margin amount will be 16,500 rupees. Plus, of course, the premium of buy option that you have paid. which will be significantly lower. So all put together, probably, that is, I told you, is around 150 rupees, 150 into 75, let us say some 8,000 rupees. So for a 24,500, or let us say 25K, probably you will be initiating a spread option. Okay, so it is well within your ability to fund. Okay, with a very limited view, with a limited risk, because two important things that you must understand. First of all, you must assess whether you are a good trader. With all respect to everyone who is listening or having come to this webinar, good trading or very intelligent, smart trading and a trader who is a winner is very hard to find. According to the statistics, it's just 1% or 2% who has been consistently successful. Maybe you do a trade today, it may be successful, but I'm saying over a period of time. Okay, not that it requires only resources, which many of us may have. The question is risk, and more than that is the mental makeup, the psychology of facing loss. So these things normally have an impact, and those who can overcome all those aspects and can do trades consistently based on the system signals which they have back tested and you are using it, only those cases can be successful. In remaining cases, most of the time will fall apart and probably will quit with loss. This is a very, very general practice. You ask any member or you ask any of your friends who have been trading, probably they will say the same thing. So if we belong to the category where probably we feel that one, we cannot allocate much of a time. Second, we have limited resources. Third is our psychological mental makeup on so many other aspects is not suitable for trading. So in that case, you look for something like an investment. When you are in derivatives also, you can convert this entire idea of a trading structure of a credit or put spread. If you put it consistently, then that becomes an investment. So one way you talk about investment is, in a way you can say investment means consistency. That is, you stay, whether in any company you invest, probably you feel that the company will be governed properly, the results will be good, so you invest in the company. So over a period of time, let us say it does well, then in that case you are rewarded. So similarly, let us say you take an index or you take some other asset class. If you have a general view about the particular asset market, then in that case you know which structure you should put consistently for you to make yourself a winner. Now, why do I say that? Index, let us say Nifty. Everyone knows that from some point of the time, Nifty has always climbed higher, right? It may have all this thing, but over a period of time, it is like this, right? We have seen even last year, today, probably 10 years back, yes, higher. 3 years back, it is higher. Question is, the percentage could vary. Probably in the 3 years, the performance may be something like 10% per annum. In 5 years, probably it is 15% per annum. It could be like that, right? So there is always except for a short period of time, generally over a period of 3 years, okay, you will have profit. Over a period of 5 years, you will have profit. Question is whether it is 10% or whether it is 15% or it is going to be 5% or 6%. Now, already you may be familiar in futures, because if you are already trading, I think you will be familiar either with the stock investment or stock trading or the futures trading. Okay, option we may not be that familiar, but futures, it's very much known that you buy and sell like the way you buy or sell a particular share. So it is our common knowledge that futures normally, except for some months, futures always carry a premium, okay, compared to the spot. So the futures minus spot normally over a period of it will have something like 4 to 5%, right, per annum. Now if you see also month to month, now it will be 60-70 rupees because if you divide it by 5 divided by 12, it comes to 0.4% or so. 50, 60, 70 rupees normally now is a premium from one month to another month when you roll over. So this is a cost that you pay in the case between a cash and futures. So if the cash market rallies, that is on a particular year, let us say compared to last year, This year, let us say, the cash market, the rally has been only 5%. Let us say it is 5%. If that be the case, in futures investment or trading, whichever, I wouldn't say futures trading, because you bought at the same period 1 year and you're just carrying it, rolling it over probably. It's not that no, you put some stop loss, you have not done that. Just instead of cash market benchmark ETFs, you just bought a futures because you wanted to save a little money, because if you invest for 75 shares in the ETF for Nifty based, you may have to pay 11 lakhs. As against that, you are paying only 2 lakhs or plus with some MTMs. So I would say that you are an investor. You are not a futures trader, but you are a futures investor. Let us say come to the same place. Now, if the cash market return is 5%, the futures market investment is 0, right? Because you have paid a 4 to 5% carryover cost by rolling over the cash to futures. So you are not going to get money. Now, if you have, let us say, the total cash market rally is 8%. Then in that case, you get in futures investment, you will get 8 minus 5, which is the interest rate you have paid, you will get 3%. You will get 3%. But instead of 11 lakhs, you have invested only 2 lakhs here, okay, in futures, which means 20%. So you normally it's 5 times, right? So it's 5 times approximately. So the investment for this 2 lakhs will look as if it is 15%. It's 15%. So on an average, let us say we are getting 8% per annum, 9% per annum in cash market right now. Then those who are looking for 15-20% return per year should normally invest only, instead of 11 lakhs, just invest 2 lakhs. Okay, you get this return. So remaining 9 lakhs, you put it in FD and get some 6% return also in that. So that's a very decent way of doing to enhance the total return on the total investment of 11 lakhs. So here you get 9 lakhs or 6% you get. So probably that is almost 80%. So on 80% you get 6% return, right? So that is 4.8%. On 20% of that, on this 20% you get 5% return, which is 3%. Okay, so you get overall return is 7.8% compared to your futures compared to an FD, which is 6%. So if you allocate a little more, then probably you can just change this ratio. If you have done 70% in this into 6, this becomes 4.2. Under 30%, if the rally has been only 8% in a year, so you get 15%, so you get 4.5. So you increase it to 8.7. So you can slowly increase it. If you want something like 8 to 9%, then in that case I would suggest that you go for 70% investment in FD and 30% investment in the futures investment. Because normally over a period of 3 years or so, you will get something like approximately 8% per annum to 10% per annum. I am only talking about 8%. If it has been at 5% per annum, in that case these things will definitely 5 into 5 becomes 25. So this will increase substantially to 9 to 10%. So that you get also, okay, you get that also. So good chance that with a mix of this, you will be able to get 10 to 11%, which is a fabulous return, which is almost double the return of what you get in FD. So to that extent, FD plus 20-30% investment in the futures market, hoping for a 10% return over a period of 3 years in the overall market, which means the futures market returns 5%, you get, so you make your money. So that is the wonderful aspect of futures. Don't leverage. Only thing is you should do only to the extent of the 20% on that 11 lakhs. So just because you have got 11 lakhs and 2 lakhs is the futures, if you go and invest 5 times, okay, then probably the profit or the loss will be for the 5 contracts will be for not 11 lakhs but into 5 times for 55 lakhs worth of normal cash market. It may be a fabulous return or it could probably drop you down during times of extreme fall. So you need to be careful about it. Now, the next step that you take from the futures, that is that you try to see whether this return, that is the money that you are putting in futures, okay, should I put that 2 lakhs for me to earn that return? Now the question comes, should I put that 2 lakhs? Suppose if I put 50,000 itself, Can I get the same return profile? Can I get the same return profile? Now that is where if you make an analysis, then the option structures will be useful. Whether it is, then look at whether buy option or sell option becomes useful. So option structures now, I'm just making a statement. Option structures probably can increase your return or give the same return like a futures, but for a much lower investment, probably 20-25% of that particular investment, which means that a person doesn't need to have 11 lakhs. First of all, we brought it down from 11 to 2. Now from 2 we are bringing down to 50 lakhs, 50,000. So that means it comes now within the affordable bracket, that instead of 11 lakhs of investment, instead of 2 lakhs investment, you are not dropping down yourself to 50,000 rupees of investment. Now, where do you then stand? Now then, in that case, what should I do? Should I do a buy option or whether I should do a sell option? Now, for new traders, for those who are entering the trade, so selling the option, it will be profitable. I will show you theoretically it's perfectly possible. Question that it is a psychological problem, because now we have come to the option structures for two reasons. Like, we should not become like a trader who probably loses. We should be like an investor, and an investor should not get into psychological issues of trading. And then you should also ensure that probably the amount of funds that you put is much lower. Okay, funds lower is satisfied. Now, how do you look at the psychological aspect? Now, the psychological aspect, only if you sell only an option, okay, probably for an individual trader, it will have an impact on his behavior. The reason is, you will always think that tomorrow an untoward thing happens. Like we talked about black swan. What if that black swan happens again? We said black swan normally happens once in 5 years or once in 10 years. How do we know? Probably there can be 2 black swans even in one, because a lot of things which we have not seen in life are happening right now. We saw tsunami, we have seen corona, all these things we have not had experienced prior. So it cannot be written that such black swan cannot happen again two times in a year or so. So we need to be guarded. And at the same time, policy response also can lift the market also significantly, right? So there is an even chance of the market also going up. So in that particular case, selling the option, okay, though generally it is profitable, okay, generally first thing that we are going to see. Now, second thing is whether buying of a put option or selling of a put option is going to be helpful. So there are a lot of myths. If you don't do a statistical analysis, probably you will get carried away by just buying a call option. Then you will find that there has been a 45% chance of a loss, and overall you struggle to get profit. These things happen despite market going up. Why? Despite market going up, you are either you make a loss or make a meager return in buying a call option. It's because of the premium that you pay. Now, bring yourself back to the table of insurance company. Now, who wins there? The insurance policy holders, okay, is happy that problems doesn't happen. That is okay. But you tell me that the insurance company, is it not making profit? It is making profit. So either it is equivalent to saying that either you sell a call option or you sell a put option. Now, which is most convenient for me? Now, if I say the buying call option just gives me a meager return, selling a put option, I told you selling a put option is as good as expressing a view on the buy side. That is, buying a call option and selling a put option means the same thing, that you are taking an upward direction in the market. So, I feel now over a period of time the market goes up. So, whether I should be a buyer of a call option or whether I should be a seller of a put option. This is the question. If you look at it, statistically it can be very clearly shown that buyer of a call option can have losses also, or the return can be meager compared to a seller of a put option. One, seller of a put option sometimes can make money equal to the futures return or better than the futures return. At the same time, in a very, very big bull market, the selling of the put option, because you only receive the premium, the market rally cannot compensate only for the premium that you have just received. So the market rally could be 500 points, you would have received on 150 points. So you will not be able to lift yourself commensurate to the market rally. In that case, how many contracts do you need to do? If you are to do that much of contracts, what is the margin that is required? Now, I told you about the selling put option as a psychological problem. The psychological problem of what will happen if a black swan event just hitting the market at this point of time. So that brings you the question of, should I do a spread structure so that if something wrong happens, like a stop loss, I just keep some strike, buy some strike at some lower premium at a far off level, which is an unlikely event which may not happen at all, but I don't mind sacrificing some profit from the sell put option in that, but I still make money. Second thing is, after that, what I do is I compensate for this by doing more than one contract, by doing more than one contract of spread option, so that my return in doing this particular credit structure, credit put spread structure, is in a position to equalize the rally in the futures. Question there will come that in that case, if it is going to equal the rally in the futures, why should I do the spread? I can as well buy the futures. Okay. Question is, in futures, you need to pay more money. Here I told you, brought down from 2 lakhs to 50,000 or 25,000. Second thing is the psychology of the market falling up, going up and down, where you can make a mistake. But whereas in the case of a sell put structure, you know that the market, even if it falls without you be able to do anything, still you are protected because you have bought a put at a lower level. Because of this, you feel comfortable in doing a structure like this. So let us look at what has happened to a buyer of a call option, to a seller of a call option, to a buyer of a put or a seller of a put at a weekly basis. Now, you can analyze this. Now, we have got two tenors of option. One is a weekly option, another is the monthly option. Now, today we are going to discuss some aspects of the weekly option. We will also look at the monthly option in coming webinars. We will also look at many more structures of these particular options. Then we will look at other asset markets also. So today we will just focus now on what happened from the period of, say, January 2020 beginning till the last week. Okay, I think April 18th or whatever it is. We have not taken the last 1 or 2 weeks only. So what has happened till then? Okay, what has happened till then? If you look at this, the entire rally from January 2020, okay, it's been around 20%. That is, on a cash market, it was 12,200 at that time, and the last one which you took was 14,350 or so. So this return is something like a 20% return. Okay, 2,100 points or something like 17%, right? So something like 17% return on absolute value. Okay, so 17 to 20%, we'll keep it like this. Now, if we have bought a weekly option very consistently, call option consistently, okay, and if you have paid the premium, the last 1 year or so, the average premium of the at the money option. Now, I wouldn't, because of lack of time, I'm not going at what is at the money again. The at the money is normally whatever that is there, very closer to the spot or the futures, okay, at that point of weekly. Let us say this week it closed at 14,650, then 14,650 becomes the at the money option, okay, for the week. So now, let us say 14,000, so if you have bought every week a call option, and at the end of the next week, you close, it automatically gets closed, and then you buy again an option. That means you just roll over the option. Okay, if you have done like this, okay, if you are a buyer of an option and if you have done like this, okay, what is the return that you are going to get in this? What we found in this entire period of so this we will explain to you. Okay. Now, from January 2002 till last 2 weeks back, the number of weeks were 68 weeks, out of which 38 weeks were positive. Now, 68 weeks from January till date, out of which 38 weeks the market closed in the positive, 30 weeks it was negative. So always normally you go, there will be a ratio of 55 to 45 gain. If you look at this also, it will tell you very clearly 30 divided by 68, this is 44, I put just 45, I put it, so 55. This is normally the ratio. I told you that through many weeks, and if you do it, the ratio comes to be a call and put option. Trades of profit is 55 to 45. So if you consistently buy a call option, 55% of the time you will win, 45% of the time you lose. So if you are asking for the number of trades of success or profit, this is it. Now what is the return that you have got? If you have done all these things, okay, I am not talking about on the option premium that you have paid. I am only talking on the value of the market, which is, if it is 14,300 or whatever it is, okay, the return that you have got over a period of time. I told you 20% is 17 to 20% is the return that you have got in futures, okay, or cash market probably that we have seen. Because if you have taken that as a cash market, then the return was something like, we talked about 20%. So let us say now it's 1.5 years gone, so minus 6%. So in futures, probably the return would have been just, it could have been 14% for the futures. But because you are leveraging it 5 times, the return is still good. But I am saying that no, this is the return there. Now in this trade, if you have bought a call option consistently, then in that case your return, that is if you are buying the call option exactly on the spot itself, I am talking about you are buying on the spot and you are paying a premium. The premium comes closer to 1.4% in the last one since January. The average premium comes to close to 1.4% for the at the money trade. If that be the case, the return that you would have got is only 7.5% in buying call option. The return that you have got is only 7.5% in call option. Okay. Now, this is an entirely a bull move, right? So in entire bull move, you would have got 7.5%. Okay. So if you wanted to match the futures, you should have done double the contract. You should have done almost double the contract. The reason one advantage was there is basically compared to the spot, it is slightly lower, so you should have done slightly more than 2 times. So probably compared to the spot because of the interest rate gone here. So the spot the volatility that we have visualized, suppose if it should have been exactly 2 contracts of call option, if it has just matched this particular futures thing, then probably we can say that it has matched the volatility which was there in the priced by the option. Now it has not happened, so there has been some dip compared to the option volatility. There is some amount of weakness, I would say, because maybe it has realized only to the extent of probably there is a 20% drop in the volatility compared to the option volatility that is indicated. So it is a little bit technical, I don't want to go into that. So this is a 7.5% return is what you would have got by buying an option. Now we also made an analysis, that is very clearly the 7.5%. Okay. Last year has been an extraordinary here in terms of upside movement also. Okay. So you may now ask me a very relevant question after I give you information. What we tested is, we took out of the, because a lot of people ask you for out of the money option. So we took out of the money option at double the option premium percentage. Suppose if the option premium percentage is 1.4%, then we took a strike which is 2.8% away from the spot, which is 2.8% away from the spot. That means then we looked at the performance. Okay. We looked at the performance. We got, for that, the return that we got is amazingly we got 14.25%. 14.25% for that. You may ask me why it is. That is out of the money option gave 14.25%. Okay, better than even at the money. Is it possible? It is coming through mainly because there is lot of wastage of the premia here. Okay, so the rally is being sucked by the premia substantially. But whereas out of the money option in call option normally goes for a much lower volatility compared to at the money option. And because of that, you normally pay, if it is 1.4% for a doubled option premium percentage, normally you will pay only at 20% of this, that is 0.28. Now, the number of trades of success to loss is very less. If you look at the number of trades which made success in this entire 68 weeks, in the entire 68 weeks, only 10 weeks were positive above this. Only 10 weeks were positive above 2.8%. 58 weeks you lost by buying the out of the money option, by staying invested in that fully. Okay, but that 10 weeks, okay, because in this entire remaining 58 weeks you lose only 0.28%, because 1.4 in that 20%. So you lose only 0.28%, right? So this entire thing could be 58 into 0.28, right? So you lose something like 14% or so, right? You lose some 58 into 0.28, 16%. Okay, so you lose 16% in this. You lose only 16%. But in those 10 trades, we got something like a 30% after paying for the premium. There are only 10 weeks, right, that positive. So 10 into 0.28 is only 2.8%. But the return that you got in those 10 weeks is because one particular, see, on the budget day itself, the market rallied by 7-8%. So that day you would have got something like 4-5%. So even 2-3 good weeks of a significant rally probably gets good return, and the remaining periods when you lose only this much. So here is a classic case that which produces a positive return, but with only 15% success and 85% going at a loss. And very clearly when we said we are putting at 2% above the ATM, you just saw that only 10 weeks, which is only around less than 15%. So 10 divided by 68, which is around 14.5%, which is the one standard, because 14.5% is this side and 14 approximately 13.5, or 18.5, sorry, 17.5 this side and 17.5 this side. So now this 10 weeks out of 68 is only 14.7% chances of that thing. So it is even lower than the 17.5%. So there is a chance that 86% of the time you are losing and 14% only you are making wins as far as number of trades is concerned. But the profit that you got is something like net profit that you got was 14%, 14.5%. So normally we have seen out of money call, which is at around double the option premium percentage, gives a very good return. And what we found out is that this was not only applicable during that particular time, we also saw that even if you take the period which is only in the bullish period, that is we removed the January to March period, we took it only from April period, which is around the 55 weeks. This is approximately the 54 weeks. And if you see there also, if you are paid at 2.8%, then the return that we got in the normal call option, at the money call option, so only from April to April, if you look at from April to April, this entire bull period, then the normal at the money call option gave a return which is around 12%. And out of money call option, a doubled option premium, which is around 2.8% away from the normal strike, it gave something like 8% return, 8.5%. So in those two periods that we have seen in this 2020 to 21, we have seen that out of the money call option has given a return which is sometimes better than the normal call option, or only slightly inferior doing sometimes. So very clear thing is that the out of the money call option is something which can be considered, because you pay only less amount and you have an investment. If you are buying an option and probably you are paying 30 rupees, 35 rupees into 75 is only 2,500 rupees. But be sure that you lose 85% of the time and only 15% of the time you will win. That means if you're doing 50-60 weeks for the entire 1 year, 52 weeks, there's a chance that you may win only 7 or 8 weeks. Remaining periods you will not win. The remaining periods you will not win. So, but when you win big. When you win big. So that is the out of money call option which has given you that particular return. Okay. So keep in mind, more losses, more percentage of trades of losses, but still produces a positive return over this particular period. Now, what we said very clearly that the first one, that is the market since January 2020 had given a return in futures which is only 14%, and in the cash market it was something like 20% or so. But out of the money option in this particular period gave 14.5%, which is even better than the futures, right? Which is almost better than the futures, and not very far off from the spot, which means you just required so much of less amount of investment. Even from April to this period, if you look at it, the overall gain in the market was 47%. That is from April to April. April to April period, you got 47% in the cash market, maybe minus 5%, so 42% in futures. In futures market. Okay. And the call returned only 12%. Out of money call returned 8%. 8%. Okay. So in a very, very bullish scenario, that particular thing has not still been replicated to the extent. See, in the call option right now, it's only 12%. So what should have happened? This call option should have returned at least, one call option should have returned 24%, right? So that two call options when you buy is equal to the particular cash market return. So one call option, so that means it has just given only 50% return. It has only given 50% return, which shows very clearly that probably the volatility is still not sufficient to the extent the option price volatility is priced. Okay, one thing. Second thing, normally we must understand that I told you 60-40 is 55-45 is the ratio of victory. 55-45 is the ratio of victory. Now in this case also, we have shown out of 38 weeks, 30 weeks is gone. 38 weeks positive, 30 weeks loss, right? Right. So net is in this particular thing, if it just matches the option volatility, that is, or the option volatility, if it matches means what I'm saying is, if you are paying 1.4% premium, 1.4% premium, the minimum that you should always get as a profit is around 2.8%. Then only you will produce a return. It's a 2.8%. Now this 2.8%, if you produce a return, then in that case the net profit that you are going to get here is 1.4. The net profit that you are going to get is 1.4%, right? But in 30 weeks, you would have lost at 1.4%. This is the option premium paid. So only for 8 weeks into 1.4, you will get only something like 12%. That is, even if it matches the volatility, that is, if the option volatility, normally option volatility, they will price it higher because the sellers want to take an upper hand, because it's like an insurance company. See? So normally you will have a volatility which could be slightly lower than what the option volatility has been priced. Assuming it matches, only in very few cases it will exceed, consistently it will not exceed. If it matches also, and if for the entire period that you have done, your return cannot be more than this. Even if you, there can be upward, downward movement, all those things. And the return, if you look at it this time also, in the last 1 year or so, the return has been 47% in futures. The return has been 47% in futures, but in the call option it is only this much, because in the entire 68-week period, there has been 30, though the market has generally gone up higher. It will look as if, you'll have. So, the market has generally gone higher, but with the 30 weeks loss, which is a 45% period of loss, that 45% period of loss, you had an option premium loss, and the remaining period it just compensated only to a small extent, and this will be the pattern in doing this. So the call option, if you say, if you feel that it will give a return which is equal to the futures return, generally it will not happen. Even if you buy 2 times also, it may not happen. So it has to, if it does happen, then the upside volatility has to be so substantial that you need to make a profit which is very much, considerably much higher okay, which will not happen consistently. Double this, because normally you will have volatility, it will not exceed that particular volatility significantly. So the chances is that this will be the thing. So your understanding of the call option should be is it will give a substantially lower return compared to futures. Probably it will give only 1/3 or 1/4 of the total futures return that is possible. 1/3 or 1/4 is what you will get. So in that particular case, how many contracts that you need to do? In this particular situation, we have seen that immediately you should have done some 3 contracts or 4 contracts of call option to have brought in your thing which is equivalent to the futures market. And in that particular case, what should be your investment? So in that particular case, you should always look at, say, if it is a weekly option, probably you are paying 150 to 200 rupees as an option premium, which is 15,000 rupees. So 15,000 into 4 contracts at least you should have done, which is something like 60,000 rupees, which is still significantly lower compared to your futures. So compared to doing one futures, probably in all these things you should have done a call option which is 4 times, which is 4 contracts, equivalent to 4 contracts or so. If it is a out of the money option, it is just enough that probably you would have done some cases you could have done even 2-3 contracts. Some cases you could have gone for 5-6 contracts. But there the amount is lower because you look at the investment, it is going to be only 2,500 rupees or so. So even if you do 6 times, okay, 6 times, you are going to be 15,000. But 15,000 rupees you will lose in more than if it is 10 times, you lose 8 times. So you need to put that money, extra money at any point of time and then keep moving it up. So you may get frustrated. So that is the psychological aspect as far as buying the out of the money call option. So then what is the parameter that probably you need to look at it? Now we are running out of time. So I would just summarize today, because unless I explain to you, probably I could not explain to you why the put structures and why the sell put structures are going to be very important. Now the sell put structures generally have done very well. Okay, sell put structures have done extremely well, and we will give you the profit profile next week, and also we will highlight to you that how basically how many contracts of a spread structure that you should do, what type of strikes that you should take, and what combination of we told about out of the money option is doing well. So with an out of the money call option, with a spread option, are we now looking at very substantially low investment with a possibility of a very high return, So whether we can just invest 40,000-50,000 rupees and get the same return that we get in a futures market, or are we going to get the same return which you are going to get in 11 lakh to 12 lakhs of investment. So please bear with me for next week because of the time constraint which I have to stop now. I am stopping now, but we will carry forward of the put structures, put credit structures, put spread credit structures to show how the profit profile is and how many contracts we should do and what is the investment that is required. With that, we will also look at some other structures. Then we will carry forward up to monthly contract and then possibly a combination of monthly or weekly contract. So all these things will definitely enable you to stay psychologically comfortable and make money consistently over a period of time. So thank you. Stay safe and please ask your questions now. Thank you very much. So shall we conclude for the day, and looking forward to meeting you again on Monday, and there also we will talk about option structures, and if at all those option structures, since this has been a quite interactive this one that is going over a period of time, I don't want to cut and jump to some other topic. We will carry forward this discussion along with whatever that we have mentioned on Monday, and we look forward for your participation again. Thank you very much. Stay safe. Good night.